Most people know that pensions can be a tool for tax efficiency, but far fewer people properly understand pension carry forward and what a powerful tool it can be when structured properly. We meet successful people all the time who earn well into the six figures but are leaving significant planning opportunities on the table. So in this video, we're going to take a simple example of a £200,000 earner, and we're going to see how over 3 years they could use pension carry forward to reduce their tax bill by 60% and gain a year's worth of free income. Okay, the glorious UK tax system. They don't make it easy to understand, do they? There's a great deal of technical complexity to understand and stay on top of, which makes it very easy to miss opportunities. But the strange thing we find is some of the biggest mistakes we see don't come from technical understanding, they come from execution. It's the people who think that they're doing the right thing on the surface, but perhaps through decision fatigue or poor timing, they're not receiving the outcome that they should be. One of the clearest examples is the number of high earners we meet who know about the effective 60% tax rate, and they think they're doing the right thing by maximising their pension contributions to avoid it, but they are accidentally still falling into the tax trap and sometimes not realising it. The 60% effective tax rate occurs for people with an income between £100,000 and £125,140. Now, you've just hit your first six-figure salary. Fantastic, we're loving life. We can now afford to shop at M&S. The UK tax system is not loving us. You've just fallen into the tax trap. You'll now start to lose your personal allowance, and this creates the marginal tax rate that sneaks in and craps on our M&S party. But it's okay because you know about a lovely little thing called pension carry forward. Now, carry forward is not just a pension strategy, it's a tax planning strategy, and when used correctly, it can completely reshape how much of your income remains in your pocket rather than in HMRC's. This video is not a complete explanation of carry forward, as there's already fantastic explanations online which I will link to. You just need to know the basics for this example we'll be working through today. The standard total amount you can contribute to your pensions within a tax year, including employer contributions and tax relief, is either £60,000 or your salary if your salary is lower than £60,000 a year. Above that, your contributions will be taxed. Carry forward allows you to use any of your unused annual allowances from the previous 3 tax years. Those are the basics, but what you should actually care about is what difference can carry forward make to my life. So let's imagine Dave. Dave earns £200,000 a year. He personally contributes £10,000 to his pension and his employer contributes £6,000. Dave is fairly typical. Dave has a comfortable income, he has a busy career, and he might already be shopping at M&S. He's probably vaguely aware that he should do some pension planning at some point, and that is where a lot of people stay for many years. Financial procrastination is a massive mood killer for financial growth, especially for high earners where their earnings are high enough that the inefficiency doesn't immediately hurt, but the tax leak creeps up until it's too late and they realise that their ship is sinking. Let's start with the status quo, and I don't mean the rock band. We'll see what would happen if Dave kept doing what he was doing for the next 3 years. He gets paid £200,000 a year, which will be £190,000 gross after his 10k personal contribution, and on that, he will pay NICs and income tax. Over 3 years, his income tax bill totals at just over £215,000. That's a 38% average rate, considering the different tax bands that he passes. Between his personal and employer contributions, he's only using £16,000 of his annual allowance every year. Remember, he could have used up to £60,000 each year. So Dave is clearly not doing himself any favours here. He is massively underutilising his annual allowance, and he is paying far more income tax than he should and could be paying. Let's look at our first alternative scenario, which I'm going to call all at once. Dave has been watching some Martin Lewis. He's heard about pension carry forward. This is fantastic news for Dave. He's realised he's left £312,000 of unused allowance on the table, and you could guess what Dave's thinking. He is thinking, well, hey, let's use this bad boy up this year, and then from every year going forwards, I will max out my £60,000 annual contribution. This isn't a bad strategy for Dave. In fact, his 3-year income tax bill could go down £111,000 from 215k down to 104k. If Dave did this, he would lower his income tax rate effectively from 38% to 18%, and he would build up to 6 times more pension wealth over the 3-year period. Now, lots of professional financial planning conversations would end here because the changes have been substantial and the framing has changed from being a far-off pension strategy for a long-distance retirement product to being a current-day tax strategy. Lots of younger people are stuck in this framing of seeing their pension as a later life consideration, when really pensions are about creating optionality. Pensions give you control of your tax positioning from today, as well as playing an important role in estate planning and intergenerational wealth. When your wealth starts to accumulate, that is when the question should switch from how do I retire to how do I structure my retirement the most efficiently. If you're at this point, then what I just showed you looks great on paper, but it's going to stop being good enough for you. So let's go back to Dave and now let's do a proper job for him. Scenario 2, the optimised plan. If he uses his full carry forward all in year 1, then his taxable income reduced to just £14,000, meaning he was cashing in most of his tax relief at 40%. Even on the surface, you can see that this does not appear the most practical, only receiving a net pay of £7,900 from a 200k salary. You might have to go back to shopping at Lidl on that budget. But he's also forgotten something very important, which we've already spoken about. Can you remember what it is? Our good old friend, the 60% tax trap. Dave would get most bang for his buck if he structured his contributions strategically to try and reduce his income as close as possible to £100,000 each year with the available allowances. That would minimise his exposure to the 60% tax trap across all 3 years. The result? An additional tax saving of £18,000 across the 3-year period. When he used his allowances all at once, his income tax was still over £100,000 and his net pay was still under £200,000 over the 3-year period. We have now crossed those thresholds. If we take a look at his 3-year compensation breakdown side by side for each of the 3 scenarios, we can see that his total income tax across the period has been reduced to £129,000 compared to the status quo. From the original 38% effective rate, his income tax is only 15%. That is a £200,000 salary with 15% income tax. Same overall allowances, same pension environment, completely different outcomes through strategic, optimised planning. Dave can afford to shop at M&S still, but he can now also afford a third space gym membership. He's working out, he's eating healthy, he's looking buff. Dave is a bit of a catch now with that pension. But hang on a minute, didn't I say at the start that Dave also got a 3 years worth of income? Under status quo, Dave's total net compensation from his 200k salary was 128k. And across the 3 years of carry forward under our optimised strategy, Dave has got 129k back in his pocket from tax saved. So in just 3 years under our optimised carry forward pension strategy, Dave has earned a year's worth of net compensation for free. That wasn't achieved through exotic investments or through aggressive tax planning. It was achieved simply through properly understanding the UK tax system, being deliberate and being strategic. For higher income levels, small inefficiencies become huge differences over a long period, particularly for business owners and professionals who are already operating in complex tax environments. But this is exciting for Dave as we've gained him a few percentage points just through one small area of financial planning and just through 3 years. A few percentage points here and there can very quickly amount to large sums. Right. Best time of the week, takeaway time. Now, Dave was of course just a work through example. This was not personalised advice. If you think this strategy would be useful for you, then we strongly recommend you speak to a qualified independent financial advisor. But for today, here are 2 key takeaways for you. Number 1, ditch your status quo. A lot of high earners I meet are incredibly cautious around pensions because the rules have changed repeatedly over the last few years. they've frozen and they keep delaying making a decision because they fear making the wrong one. But ironically, no decision usually guarantees a worse outcome than a decision, even if that decision is not perfectly executed, like in our first scenario. I'll give you the truth, even the best financial planners cannot give you perfect certainty over the right decision. We will sometimes have incomplete information, the government will change the rules, markets will move, and life will change. That is why we do not aim for perfection, we aim for what is optimal for you. Number 2, don't be generic. If you're going to make a decision, don't just settle for a generic solution that you've read about online. The real value of financial planning rarely comes from knowing a strategy exists. Many intelligent people can Google pension carry forward. The real value comes from optimized sequencing and execution, understanding the timing, the interaction effects, the trade-offs, and how one decision affects the other. Now that requires you to actually sit down and think through the full picture properly. And that is usually the missing piece, because successful people are very good at earning money, but are less good at having the cognitive bandwidth left to sit down and structure it properly. But if you're looking to get help with the full picture, be skeptical. Top financial planners will not just tell you to use carry forward, they will make sure that you're using it in the most effective way. Because the wealthier someone becomes, the more important thoughtful consideration will be. So that brings me to the end. Hopefully you can see that carry forward is not just a far off pension strategy, it's a tax strategy. So if you pay income tax, it's a strategy you might want to think about today. This is our Chief Happiness Officer. Have you been maximising your £60,000 annual allowance every year? Do you know your effective rate of income tax? Did you know that carry forward is not just a pension strategy, it's actually a very effective tax planning strategy that could potentially halve your income tax bill